Good evening, Doc Severson here for the Theo Night Report for Thursday, March 16th. Okay, all the pieces are in place, and I think now we are starting to build the extended range that I've been looking for so long. Now, I know that between Don and myself, we've turned into Pete and repeat in terms of thinking that the price will fade here. My current forecast for this is that, yes, we would expect to see a fade here, but I'm expecting this just to pull into a slightly larger range than it currently is. So pulling into something like this type of a range here, which is not unlike what we saw here and all of these other areas where we had similar exhaustion levels turning into just a choppy range, which extended the downside to set up the range to begin with. So how does that happen? Well, for that to happen, we have to look over here at the daily chart here. So the daily chart here is now starting to put in, and the last two positive days that we've had, big positive breakout days like this, is the State of the Union address a couple weeks ago, and then yesterday we had the Fed meeting. Hey, everybody, we're going to raise rates. This is tremendous. This is terrific. Well, of course, the market rallied based on the certainty that came into the market of not only just getting the event out of the way, number one, but also having a better read in terms of how many hikes were going to occur this year. So the market got a lot of certainty from that. But what is a very dangerous signal here is potentially the lower high. And actually, this is a key reversal bar here. It doesn't look like it, but this is a key reversal bar as the price made a higher high but a lower close. So that by itself is a key reversal bar. Now, of course, what you're going to hear from every analyst out there is going to say that key reversal bars need to have confirmation for them to work, which is another way of saying that single bar key reversals typically don't work all that well in terms of just the efficiency of them. But watch for this to be a lower high setting up, and maybe we are going to see that range pulling up. And I don't know where the bottom of the range is going to be. A lower high, if this sets up as a lower high, it's going to very quickly establish the lower end of that range. And again, I'm thinking that it could be as low as somewhere around 2,300 on the S&P. Now, what kind of strategies can we trade based on this? Well, there's a couple of ways that we could do this. First of all would be to set up a directional put spread to the downside for these, and that if we get an extended range to the downside, those will work out very, very well. So right now what we have into the monthly expiration for April is we have about a 6.9 point expected move on the spiders. Now, if we go back over to the spiders here, 6.9 points, right, is going to be, let's just say 7 points, and that's going to put the downside target to somewhere around, just north of 230 on the spiders, which would make sense. And that would be kind of going along with what I'm thinking, that it's not going to be a huge downside move, just an extended range. That's all. And again, the reason why I'm calling for an extended range is because we have exhaustion signals like the type that we haven't seen in a long, long time, both at the monthly and at the weekly chart basis. And that is based on the linearity of this move here, which is extreme. And if you go all the way back, and this is what the monthly chart does to give us context for this, it goes all the way back to last February, which was the bottom of that move down here, right? So all the way down to here, and it's counting this as one big swing. And so that is an enormous swing to go from 180 on the S&P all the way up to 240 on the S&P. 600-point move without a pause in there other than the this pause in here, which was right after the Brexit. So a couple of trades that I like here are actually the low probability iron condor. So this is an iron condor with a 1-to-1 reward to risk. And what we have to find is something that gives us enough of a wingspan that makes it worth it. And right now, actually on my scanner, nothing is coming up on here. Nothing is coming up. Now, the other type of trade that we can take is on trades that have, or stocks that have gone up to recent highs and are showing exhaustion as well. So Oracle is a great example of this, as a price that has just made a big, huge move here and has gone right up to all-time highs, which is just above 46, 47 or so, and is now fading. So we've had obviously an earnings report on Oracle. It's gapped like crazy up here, and it's already being chewed into. So what we can trade with something like that is what I call a short call diagonal. Short call diagonal. This is where we go a little bit in the money on a short-term call. So we pull in a big credit from that. And then as insurance, what we buy is 1 week out and a little bit further out of the money call option for that. And that builds in a credit. And what this does is create kind of a very rapid profit peak here. So we don't have to have the price move all that much to the downside for this to pull in a very, very rapid profit. As you can see, there's almost no time required for this to burn off, for this to work very, very quickly. What we also end up doing is creating a nice reward to risk envelope, where in this case, the reward is slightly higher than the risk that we're looking up here. So if the price decides to just completely go on a bender to the upside above all-time highs, okay, we wave goodbye at it and we know exactly what our risk is on this type of trade. So that's it for tonight's report. Thanks for listening. Watch for that range to expand to the downside, and we'll talk to you soon.